Good afternoon, and welcome to our webinar series, Tedstrom Talks. This is the 19th in a series of webinars that we have been producing to offer our clients, business associates, friends, and family interesting and timely topics. This is our third webinar of 2021. Your video and microphones have been muted. However, please feel free to use the Q&A and chat icons located at the bottom of your screen to ask questions throughout the presentation. I would like to introduce you to Peter Tedstrom, founder and chief advisor of Tedstrom Wealth Advisors. Peter has 36 plus years of experience as a certified financial planner. He has been consistently recognized through awards and recognition as one of the country's top financial advisors. Peter, let's get this webinar started.
Great, thank you, Barbie. It's always good to do these. Our 19th, I can't believe that. We are, I think we're approaching 1 year in not being at our office and being at home, although I'm in my office today because my home is so noisy. I've got some work being done in the basement and they're jackhammering for the plumbing. So I'm in the office and nobody else is here other than my dog. So again, I'm happy to see or be with all of you today and really thrilled to have Burt White back with us again. Many of you have seen and heard Burt speak in the past, and you know that he offers a very enlightening, informative, and amusing presentation. Burt is a managing director of the Investor and Investment Solutions and chief investment officer at LPL Financial. He oversees a high-performing organization responsible for developing the innovative products and services that enable LPL to support advisors in all aspects of their business and evolving solutions to keep LPL advisors ahead of the competition. Burt sets the vision for superior research capabilities and ways to optimize LPL's product and platform delivery. He also leads data analytics and business intelligence, marketing and communication, our strategic partnerships with sponsors, and advisory world, the newest addition to his organization. Before joining LPL in 2007, Burt was managing director and director of research at Wachovia Securities for 10 years. He has also been an investment analyst for Mercer Investment Consulting, where he provided advice to institutional clients. He began his financial services career on the buy side of the business as research analyst for Thompson, Siegel, and Walmsley, a value-oriented asset manager. Burt, so glad to have you with us. Let us know what you want to talk about today.
Peter, look, first of all, thank you for that. I want you to know that you read that bio just the way I wrote it. I mean, it was amazingly articulated. You sounded like Burl Ives reading that. That is the most boring bio I've ever heard. It was terrible. So, well, thank you for having me. Hello, everybody. I'm going to share a screen because I am going to try to show a whole bunch of slides today. And what I hope to do is to basically talk markets. What the heck is going on out there? It's like, you know, it has been a crazy year. And if you just took the sort of landscape of the year, I mean, clearly we've had an election that was crazy. We had an epidemic that has been insane. But at the same time, we've had a market environment that's actually weathered it in a very interesting way. But sometimes we forget we're only a year away from the market peaking prior to a recession. Just in the last year, we had all-time highs in the market. We had a recession, the fastest recession we've ever had. We've had the biggest rebound we've ever seen. And now we're back closer to all-time highs again. And we've done all that in about 300 days, plus all the other crazy stuff that's been going on. Sometimes I love to see this quote from Albert Einstein. The real question is, you know, is it me or someone else that really is seeing this as pretty crazy? But what we want to talk about today is I like to talk about the three E's. Election, economy, and epidemic. Now I know what you're saying, Burt, I can't talk about the election anymore. Like that's what we did all last year. And that thing's over, for gosh sakes. That is true. But there's an element of sort of a new change of power and what that might mean. And so we'll talk a little bit about the election and what typically the markets do when a new president comes into power. And number two is we're going to spend a lot of time on sort of a little bit of the epidemic, more so the market's view of it. And then lastly, we're going to talk a little bit about the economy. And then if we've got time, we'll maybe do some questions. And I know that there's chat and Q&A in the Zoom here. And so if you go put those in, we'll answer as many of your questions as you have. So let's dive in. What you're seeing here basically is going all the way back to 1950. We have gone and looked at the first year of every president and combined them into two camps. Those that won a re-election, that is the blue line. What is the behavior of the market in that first year after a president wins re-election? And then when a new president takes office, that's sort of that orange line. And what do you note the difference? Well, typically the first year is actually better for a president that wins a re-election than a new president in office. And that makes complete sense, doesn't it? Now, typically that's because with a new president comes new policies. And the market has to sort of understand what that means. What does that mean for growth? What does that mean for taxes? What does that mean for inflation? What does that mean for policy? What does that mean for spending? What does that mean for our economy? And so typically a president that you've known, typically the first year is a little bit better. But if you look at the long term, if you look at all 4 years, now here we're looking at all 4 years, going all the way back again to 1950, looking at every single president and looking at their entire cycle, presidential cycle. And again, what you see is these re-elected presidents, that's the yellow line. New presidents, that's the green line. And you can see again, in the first year, typically re-elected presidents do a little bit better. Sometimes they do better, sometimes they do worse. But when you average them all together, going back to 1950, typically the first 2 years, a re-elected president does a little bit better. But notice what happens in the last 2 years. Man, does the new president's policies begin to come in place, and it's dramatically better. In fact, if you go through the entire period, typically a new president does better through the 4-year cycle than a re-elected president, which would tell us that if we really want to maximize the amount of money we have, we should just always have a president every 4 years. Like never vote for the re-elected president because it will always be able to be in a cycle that does a little bit better if you want to game the system here. But that's typically how that works. And it's understandable, I think. When we go through the year, typically it's the first 3 months in the first year of a new president that the market usually has to sort of get their arms around. You can see where we are right now in this sort of February to March period is typically the time where the market struggles the most. Now, the market's been doing pretty good here lately. And again, we're not talking about large movements on average. That decline there is what? -3 or 4% or so. And so the reality is on average, you have a little bit of a slow start with the new president in the market. We certainly haven't seen that so far this time. But then progressively it gets better throughout the first year and then again through the presidential cycle. One of the big questions I get a lot, and again, I'm politically agnostic. My job is to try to figure out a way to make money regardless who the president is. And what's really good about this is that, frankly, the markets are not affiliated with a party. One of the things I oftentimes get is when a Republican is the president, we oftentimes hear, but Democrats do better when they have power. Or when a Democrat is in the office, we oftentimes hear Republicans do better. The reality is neither do better. The market doesn't care who the president is. It may react some to policies, but reality, it doesn't really care. Now, here what we're looking at, it's the times when you've had, like we do today, a democratically controlled both House, Senate, and presidency. So that sort of blue wave that we oftentimes hear. Now, remember, the House is very tight. I'll show you that in a second. The Senate is essentially tied with a tiebreaker going to the vice president. And of course, the president is Democratic. That said, while it's a thin, very small blue wave, it is a blue wave, and the Democrats have control of all three of these components. What do you notice? The market does pretty good. Market's up about 75% of the time, on average about 12, which is about average return. Now, if I would have shown this for Republicans, guess what? It's the same. The market's up about 75% of the time when it's all Republicans, and it's up about 12% or so. And so the reality is, what I want to take from this is the market doesn't care who the president is. We do, but the market doesn't care who the president is. Now, one of the things I find fascinating is to go back, this goes all the way back to 1857, and basically shows you all of the difference between the Senate and what the difference in Senate seats are. You can go back to that period that you see, the 75th Congress, which was 1937 to 1939. Look at that. There was a 60 seat difference. That means one party had 80 and the other had 20. Think about that one. What a huge difference. Where are we today? 0. And we really have only seen that one other time. You have to go all the way back to 1881. We've actually seen this outside of sort of, 2007 to 2009, there was one, and then here. And then outside of that, man, you got to go all the way back. Typically having a very split Congress is rare. It's quite rare. Now, we've had a lot of times where it's been 1 seat or 2 seats, but the average is really closer to about 8 or 9 seats. But here lately is split. And then you go to the House. Now, what we've done here is just looked at when the Democrats control the House. This is the smallest Democrat-controlled majority of the House, going all the way back to 1881. My point on this is that while you do have a Democratic president and Democratic-controlled Congress, it is very narrow. And I think because of that, you might not see as much swings in policies one way or the other, and you're likely to see a little bit more middle of the road policy making, and that's something the market likes. The market typically does well, not when you have sort of very swinging elements of policy, and my guess is that might be what we see a little bit here. Let's move to epidemics. So when we think about COVID, that certainly has been on all of our minds. You could see the charts here where we had a really big spike in the end of the year and really the beginning of this year. But you started to see those really back down dramatically. You're starting to see the vaccine come through. You're starting to see more immunity come through. You're starting to see folks become more careful, particularly coming out of the holiday season. New cases are declining dramatically. Hospitalizations are following. And thankfully, deaths are cut in half from the highs, which were way too high, daily deaths, and those have been cut way down. We still got a long way to go, but this is very promising, not only for us as a nation and for a world, and from a humanity perspective, but also from a market perspective. Now, we'll get to the market in a second, but things are looking pretty good. You've actually got basically 45 states seeing a decline, a few being same, and just a couple that you're starting to see increases, very small. I have no earthly idea what MP is. GU is Guam. I see that in the bottom left. HI is Hawaii. AS is American Samoa, I think. I have no idea what MP is. And so if anyone wants to put that in the comments, I would love for you to educate me on what MP is. I meant to look it up. All right. But here's what I mean by why this is important. One of the things I like to look at is real-time data. You know, sometimes we look at economic data, things like housing and employment and GDP or how our economy is doing. But oftentimes that's a month old or a quarter old. And I like to look at daily data. What happened yesterday? And some of the things I look at is like rail traffic. If you want to know how we move things around, you want to know how our manufacturing is doing, you want to know how we are doing with sort of purchases as consumers, just go count the number of trains that are at the local train stop, because the longer the train, that is how we move stuff around in this country. Or the number of trucks on the highway. The more trucks, the more our economy is booming. The other way I look is these two. I love this one on restaurant bookings. This is actually Open Table, where you can go online and reserve restaurants. You can see that it dropped year over year at the beginning of this pandemic. It dropped year over year 100%. There was not a single restaurant open. Like Open Table, you couldn't reserve a restaurant. It's come back dramatically, but notice how it's stalled a bit. The one on the right is airline travel. Notice how it's stalled a bit. The reality is we've come back and we've stalled largely because some of the concern around this spike that we had in November, December, and early January. But as that has begun to roll over, we expect to see these numbers, the real numbers for the economy, restaurants being opened again, people traveling again, people moving around, trucks on the highway, all those things are going to begin to move higher. It's why it's so important. And let's face it, small business is the heart and soul of the U.S. economy. While small business employs about half of all Americans that have a job, about half of all Americans work at a small business, they do represent something like 99% of businesses. And so the reality is this is the heart and soul of our economy. And one of the things, there's a lot of numbers here, but I want you to focus on the two numbers that I put in blue, in green there in the boxes. In October of 2020, the sort of small business optimism index, how optimistic were small businesses? It was quite high. You know, as we sort of, it dipped way low in sort of a year ago, right when this started, it began to creep higher and higher and higher and peaked in October, September and October of last year. But then we started to see COVID come back again through the winter season. And you see how business optimism declined. It went from 104 in October to November 101 and December to 96. Now it'll be interesting to see what happens here in February. We'll get those numbers here in about a month or so, but I expect that to begin to come back. This has been following sort of the outbreaks of COVID quite closely. There is a huge, and it makes sense, but there's a huge combination or interaction between the severity of COVID and how well our economy is doing. This might be the chart of the year for me last year. It is a sad chart, but it's a remarkable one. This is a chart going all the way back to 1970 and before of monthly unemployment claims. How many Americans filed for monthly unemployment? And you can see that number has typically ranged these are weekly, by the way, weekly unemployment claims going back, they have typically been somewhere between 100,000 and 400,000 a week, depending on the market conditions. And then all of a sudden COVID hit and it was like this economy hit a tree. It bounced all the way up to the millions. We've never seen close to 1 million weekly unemployed Americans, newly unemployed Americans. And yet that hit all of a sudden. Now we've come back a long way, but not all the way. And I'll show you, I'll zoom in on this in just a second. This is pretty shocking. That chart is probably the most shocking chart I've seen last year. And it reminds me of a headline that I saw a few years ago. This goes back now about 7 years. I saw this in Time magazine. And it said this: you would rather endure electric shocks than sit alone with your thoughts, a study finds. I was intrigued. So I read the article. Here's what the article says. University of Virginia basically brought in a bunch of students. And what they did is they sat them at a table like this and said, I'm going to pay you $50 if you could sit here for 15 minutes and just think. Now, there's two like tricks to this. The first trick is you can't have a phone, a computer, headphones, no music, nothing. You just got to sit there by yourself and think, okay? And so everyone was like, sign me up. Free $50, sold. There's a second trick. The second trick is in the middle of the table, there's a little buzzer. Whatever you do, don't hit the buzzer. Just sit there and think, don't hit the buzzer, because if you hit the buzzer, it will give you an electric shock. Don't do it. Just sit here, we'll give you $50. What do you think happened? They hit the buzzer. Here's the quote. What is striking, the investigators write, is that simply being alone with their own thoughts for 15 minutes was apparently so aversive that it drove many participants to self-administer an electric shock. Not surprisingly, men shock themselves twice as much as women. Not surprised by that at all. The most amazing part later on was that one gentleman shocked himself 190 times. 190 times in 15 minutes. I love this quote. It says, one man shocked himself 190 times. And the guy says, I have no idea what was going on there. That's how aversive it is just to sit there. That's how shocking. All right, let's get back to the shocking chart. This is unemployment claims. And it really is shocking. If we zoom in, you can see this economy hit a tree. We went from unemployment claims about 100,000 per week. We'd like to see nobody not have a job, but there's always a residual amount of folks that are filing for unemployment claims. Again, 100,000 a week was where we were, and then boom, our economy hit a tree because of COVID, and it bounced all the way up to 7 million Americans filed for unemployment claim in 1 week. Followed the next week by 5 million Americans. Followed the next week by 3 million Americans. And notice how it's been getting better, but we're still every week 1 million Americans are filing for unemployment claims, newly unemployment claims. This isn't continuing claims. This isn't, I was unemployed last week. I'm talking new unemployment claims. Now, while it's gotten better, it's stalled a bit as you're starting and we're waiting for our economy to fully kickstart. It's certainly hired back many Americans, but not nearly enough. This is one of the things that is really interesting, and I want to focus on this slide because I actually feel like this is one that's just not talked enough about. Now, the slide's a little confusing because it's inverted. It goes the opposite direction than what you think. So let's focus on the blue line first. The blue line is the unemployment rate. The higher it goes, the higher the unemployment rate, the worse it is. We don't want high unemployment rates. We want low unemployment rates. Low unemployment rates means fewer Americans are unemployed. Higher unemployment rates means more Americans are unemployed. Notice the line that goes up and down a little bit, that blue line. You see it peaking in sort of 2008 and 9. That was the Great Recession. We certainly lost jobs there. In 2000, 2001 and 2, that was the tech wreck recession. So those are recessions where you saw little bumps. But look at that spike that happened really in 2000, right there, you know, at the beginning of 2020, and sort of carried into now. And while that's come back quite a bit, the unemployment rate, focus now on the yellow line. Now, there's two types of jobs. There's lots of jobs, but the Fed actually sort of went, or the Bureau of Labor Statistics, when it looks at jobs, it looks at two types. One, which it calls temporary jobs. Now, these are not just temporary jobs, but these are jobs that are more hourly. So think of this as folks that work maybe at a bar, or maybe folks that do lawn care, or folks that whatever it may be. And and then they have what they call permanent job losers, right? These are jobs that were just sort of taken out. These are larger jobs, oftentimes higher paying jobs. And what you note here is that this line actually hasn't budged much. It hasn't come back down from really where it was at pandemic highs. And so while we've certainly bounced back some in jobs, some of these more higher paying permanent element jobs actually hasn't quite come back. Now we think it will begin to, particularly in the back half of 2021, when our economy begins to start getting kickstarted again. The last thing I want to talk about is our economy. And I just think one of the canaries in the coal mine of when I'm looking at the economy, oftentimes people say, what are the things that you look at to determine how well the economy is? I gave you two of them at the beginning. I go and count, this is my first job, of which you should have memorized the bio that Peter read. But my very first job was at a firm called Thompson Siegel. And my job was to go to local train stop and count the train cars and to determine how many were grain and how many were oil and how many were freight, because that helped us understand how well the economy was doing and what parts of the economy were going. And that was a big part of my early job, was to figure that out. So truck and rail traffic is one of the things that I look at a lot. But the second thing I look at, which is maybe obvious but not talked enough about, is housing. You see, housing is a canary in the coal mine. And it doesn't necessarily mean that now's a good time for housing, because actually housing prices are up. We'll show you that in a second. But what it does mean is that I think the housing market now is signaling very bullish things for our economy for the next year or two. Now, there's there's lots of reasons why the housing market's doing particularly well right now. One is because we have to be in our houses because of COVID. And so therefore, more and more people are moving there. Folks are moving out of rented apartments because they want some space. They want to be able to have a backyard. They're moving into homes. And then also low mortgage rates. Mortgage rates are as low as they have ever been in our lifetime. And they are super low. One of the things I like to talk about as to why housing is a canary in the coal mine is what I call my 3 C's. Number one is confidence. The reality is that this is likely the biggest purchase anyone will make. You have to have a lot of confidence to buy a home. You have to have a lot of confidence in your job situation, because if you have not a lot of confidence in your employment situation, you're likely not going to commit to a 30-year mortgage for a home. So it's a great measure of future confidence. Number 2, it is a catalyst for spending. You see, my friends, when you buy a house and you sign your name on the mortgage, you also commit to buying all the stuff that it takes to run the house and to fill it up. Bird feeders and water coolers and couches and TVs and video games and wardrobes of coral shirts like Peter has, like all that stuff. Those are all things that we're going to go buy to fill our house. So when you begin to see a surge in housing, you also see a surge in spending, because we then also begin to put in all the things around our house. So it's a catalyst for spending. And third, it is a great creation of jobs, high paying jobs, roofers, plumbers, HVAC, landscapers, right? It's a big grower of jobs. That's the reason why it's a canary in the coal mine. Here's also the math. We actually see a demand every year of about 1.6 million homes. Now, where does that come from? Well, some homes just become old and they get torn down. And so therefore we lose some homes. But the big piece is our population is growing. Particularly, we're beginning to see millennials begin to move into homes as they begin to get a little older and start families. So the demand for homes is right around 1.6 million. But the actual supply of homes, how many homes are actually on the market to be sold right now, is 1.3. My friends, when you have more demand, then there is supply. Prices go up. And the reality is this is a really big piece of this. Now, here what I'm showing you is home ownership rates. And what you see here is we saw the home ownership rates really begin to rise in the late 90s. You see where I have housing bubble. This is where people began to say, wait a minute, real estate prices keep going up. Maybe I shouldn't invest in my investment portfolio. Maybe I should own like 9 condo complexes. And everyone began to think about getting into real estate in the late 90s. That didn't work out so well. That wasn't a great investment. And we began to see home ownership rates begin to move lower. And a large part of that was millennials deferring buying a home. We saw ownership rates, particularly for younger folks, go to generational lows. But look what's happened here lately. And this isn't just 2020, although that sort of kinked the curve. But starting really in 2016, we began to see it moving higher, and then COVID just accelerated it. We saw an extraordinary amount of home ownership. What does that mean? It means more jobs, because someone's got to take care of all that stuff, right? Someone's got to put in the plumbing. Someone's got to, put in the concrete. Someone's got to go and put in the new driveway, and someone's got to think about the pool. And all those things begin to happen when you have home ownership rates. But like I said, supply is very low. In fact, supply is almost at generational lows. This is the amount of monthly supply here in the United States. You can see that it is very low. This is done on months supply of inventory. Typically, we have more like 6 to 7 months of inventory. Right now, we have closer to 3 months of inventory. Now that's beginning to move a little higher, but by and large, there's not a lot of homes out there to buy. So when you mix those two things together, a lot of demand and not a lot of supply. That means there's a lot of folks chasing a very few amount of homes, and that's what makes prices go up. And we're starting to see home prices move higher. So this is very bullish too, because remember my 3 C's, confidence and the creation of jobs and the catalyst of spending is all great when you begin to buy homes, and that is going to be really great for our economy. But when house prices go up, there's a wealth effect. My house is worth more. And because it's worth more, I can either refinance and take some of that money out, or I feel a little wealthier, and therefore I might spend a little bit more. And so all of those lead to really an upsized opportunity for spending, for our economy, and therefore the markets. The last thing I would just say is we're beginning to see a little bit of new building. That's what this is. This is building permits. Folks that have filed building permits to say, I want to start building new homes. And you can see that that's on the rise, largely to meet this demand. And we got a long way to go for this. And so what I'm not saying right now is this is a great time to go out and buy 7 homes. I'm not saying that. What I'm not saying is this is a great time for that houses are great bargains. I'm not saying that either. What I am saying is that the strength of housing is really moving itself to show that that is a canary in the coal mine for good times ahead for our economy and for the market. Let me quickly end with this, and then I'm sure we'll have a few questions. Hopefully we will have some questions, Peter. The last thing I'd say is the government really over the last few years, and then continuing with President Biden, continues to provide both fiscal and monetary stimulus. Remember the difference between fiscal and monetary stimulus. Fiscal stimulus is what is done by Congress and the president. Think of that as things like taxes, maybe lowering taxes or raising taxes. But in a stimulus, that would be lowering taxes. This might be some of the relief bills. That would be fiscal stimulus that's going out and giving folks money to sort of stimulate the economy. Monetary stimulus is what the Federal Reserve does, typically with lowering interest rates. But remember, they also do something called quantitative easing. Quantitative easing is where they actually buy bonds and investments from banks. And when they buy those investments from banks, they buy it with money that they printed, which puts more money in the banks. And what do they want the banks to do? Lend it to you. And if they lend it to you, what will you do with it? You'll go spend it. You'll start a new business with it. And that's the whole theory of trying to take assets out of banks, giving banks more money so they can lend more to you. And there's been an extraordinary amount of it. If you look going all the way back to the lows of 2008 and 9, the Federal Reserve balance sheet, the amount of money that the investments that they have on their balance sheet was about 0.7 trillion. That is 700 billion. Okay, that's a lot. But it ballooned to 7 trillion, 10 times increase in 2020. And a lot of that is because they took, again, investments out of banks, put money into banks so they can give it to you, so they can lend it to you. And by lending it to you, you can go and stimulate this economy. Now, sometimes we lose sight of how big $1 trillion is. Like, we hear numbers of the big numbers all the time. So let me just go ahead and sort of try to, as best I can, to try to illustrate how big $1 trillion is. All right. So 100 seconds ago, think about 100 seconds. That was about 2 minutes. Okay. That's about how long it took me to ramble that little bit. All right. 1,000 seconds was 17 minutes ago. That's about twice as long as I've been going. I've been going for about 2,000 seconds. I know it feels a lot longer. My apologies. But that's how long 1,000 seconds is. So if I asked you if 100 seconds is 2 minutes and 1,000 seconds is 17 minutes, how long do you think 1,000,000 seconds is? So just think it in your head. How long do you think 1,000,000 seconds is? You got it? It's 11 days. So 1,000,000 seconds is 11 days ago. All right. Now, how about 1 billion seconds? Now, what I usually get with 1 billion seconds is 10 years. Sometimes I get 5 years, but the average is about 10 or 12 years. The answer is 1985. Okay, it is a lot more than 10 years. That's 1 billion seconds. So 1 billion seconds is 1985. So what is 1 trillion seconds? Like, how long is a trillion seconds? Now, the most common answer I get is 1,200, 1,500, 1,600, going back to sort of like Christopher Columbus times is a trillion seconds. My friends, that's not even close. A trillion seconds is 30,000 BC. Now, just think about this now. That's dinosaur time. A trillion seconds goes 30,000 BC. The Fed did 7 of those. 30,000 BC worth of seconds of money into our system to get our economy going. That is astounding how big that is. Just think about how many seconds it would take to go all the way back to 30,000 BC, multiply that by 7. That's how the Fed and the Fed alone has tried to stimulate this economy. It just really is extraordinary what those opportunities are, and that has really helped. Now, if the punch bowl's there too long at some point, that might actually be a detractor that could create things like inflation and put more money in the system. And more money in the system does create things like inflation. But for right now, we need it, right? We need this to sort of get us out of this. Now, we're going to have to pay this back. So imagine paying back that amount of money at some point. Well, you have to invite me back for another time on that later. All right. So here are my 4 bottom line thoughts. Number 1 is right now it's all about COVID. I estimate that by summer that we'll have real relief that could really trigger continued optimism. I'd be very surprised if we didn't see things like continued growth in our economy, that the second half of this year to see really good economic numbers, and therefore the prospects of investments continuing to do well. Employment will be a long recovery, and we've got a long way to go. While we have hired many Americans back, there is a lot of hurting Americans and a lot of Americans that are unemployed or underemployed. A lot of those really good, big paying jobs have not come back. But a canary in the coal mine is housing, and that will be a big help, because not only do you have to hire folks to build the house and to maintain the house, but it's confidence. It's also that catalyst to spend more money. And it's about buying new couches and love seats and chairs, and hammocks and bird feeders, and all that stuff. And when you buy rakes and lawnmowers, pool equipment, new sheets, and when you buy all that stuff, that stimulates our economy and gets manufacturing going again. And lastly, this split Senate and low House majority is really Goldilocks for the market, because what it really means is that we're likely not going to have big policy movements one way or the other. And because of that, the market can focus not on politics, but can now begin to focus on the recovery, which is a good place to be. Last thing really quick. My friends, the world's changing. Whether we like it or not, the world's changing fast. What we don't realize is we've been sitting here right now. We sometimes forget how fast things are moving around us. Oftentimes we can't see or feel how fast they are. And then we wake up or we walk outside or we notice that the world has changed. You probably noticed that the sun has moved on me here and I get a little sun on me. That's changed. Right now, my friends, this world is spinning at 1,000 miles per hour. While you are sitting in your seat, you are on a ride that is moving 1,000 miles. It spins 25,000 miles per day. If you divide that by the day, it's about 1,000 miles per hour. And while we're spinning at 1,000 miles per hour, we are moving around the sun at 67,000 miles per hour. And we loop the sun at 584 million miles over the course of a year. My point on this is that while sometimes it doesn't feel like things are changing, things are really changing dramatically. One of the bands of my youth was a band named Pearl Jam. I guess some of you like them too, Peter. I know you like Pearl Jam. And one of the lines from that song is, "I changed by not changing at all." What that means is you don't have to change, but the world's changing around us. And that element of change is something that we all have to begin to embrace. We're embracing that now with Zoom calls and new ways of doing commerce and ordering things to pick up on the app, food to pick up on the app, and to have folks deliver groceries to us. We have seen an avalanche of change. Don't lose sight of that. That change is going to end up being positive. Almost every big innovative, changing environment has almost always increased the standard of living of Americans. And I think we're going to see that again. I want you to focus on one thing here. The one thing I want to focus you on is something that shouldn't change. And that is staying with your plan. All this is what has investments done since the 1 year, go all the way to the right-hand side, the 1 year since we peaked before COVID. That was almost 1 year today. It was the 19th of February. So where the market peaked, COVID began to get worse in early and kind of late February. The market declined dramatically, dropped 34%, and did so in about 20 days. But look at where the market has recovered. Take it to the S&P 500, it's about halfway through there. It's up 16%, and many other investments are green. The reality is, as crazy as that was, staying with our investments is still the most important strategy. This is just an example of what the market's done really over the last 10 years. And these are headlines that I pulled from magazines that I just found over there on my desk. And every one of these gives you a reason why you shouldn't stay with the market. And every one of them was wrong. The reality is, what hasn't changed is to think about the long term with your investments, to begin to have a plan. But all the other stuff around that has changed, just don't forget that every time we've seen dramatic change in this country, it has always upped the standard of living for Americans. The last thing I'll say this before we maybe take some questions. I'm from West Virginia, and we had a farm there. My grandfather used to always say something. He used to say to me that the grass is not greener on the other side. It's greener where you water it. And I never knew what he meant by that. But as I grew up, what I realized is it's greener where you take care of it, where you nurture it, where you love it. And I think that's the true now. I think what we're beginning to realize is if we take care of each other, this world is divided as I've ever seen it. I'm 52 years old, a young 52, but I'm 52 years old. I've seen a lot, but I've never seen a country that says divided. My friends, if we could figure out a way, come together, not realize that the grass is greener on the other side of the aisle of politics or whatever our views are, and we give to nurture each other, nurture the things that matter, I think we'll end up in a great place. So, Peter, I'll end with that. Hopefully some of that made sense, and hopefully maybe we have some questions.
Burt, thank you so much. Always enjoy the energy and the information, and always enlightening to think about the world the way you present it. And one question that came up to mind, and while people are thinking about their questions, is we often get the question, isn't this time different? And what they're asking is, isn't it different relative to my investments? And I have said, well, for 37 years while I've been in the business, the result hasn't been the difference, but the circumstances have been different.
Yeah, I agree completely. I actually think the most dangerous words in investing is this time is different. And the reality is, it almost never is. That we've seen a lot of things before. I mean, just take this pandemic. Have we ever seen something called COVID-19? Nope, we never saw that. But what we have seen is epidemics before. Oftentimes people talk about the Spanish flu that happened in the early 1900s, almost exactly 100 years ago. And guess what the market did? The market declined 35% peak to trough. Guess what the market declined in this epidemic? 35% peak to trough. My friends, we've seen this before. The market has seen this before. And while it might be different names, and while it might look a little different, it might be, a slightly different words. We've seen recessions. We've seen tough times. We've seen those things. And what we know is what works. What works is have a plan and to stick to that plan. Those are the two things that work. That is timeless. And so I'm with you on that. I think the most dangerous words in investing is this time is different. It almost never is.
Almost never is. And then there's a question that comes up, since it's what 1 trillion seconds is 30,000 BC. We're at what, $26 trillion in debt. You know, that's a question that's on some of our listeners' minds, is what are we going to do with this debt? And is it as dangerous as it seems?
Well, yes. So a couple of things. Number one is that, having a lot of debt, make no doubt about it, is an anchor to growth. And so if you go back to the Great Recession, so take yourself back to 2008 and 2009. And at the time, that was the worst recession. To this day is the worst recession. We had the quickest recession here this year, but the worst recession, decline of well north of 50%, was the Great Recession of 2008 and 9. But coming out of the Great Recession, we had the slowest recovery we've ever seen. So to just put those two things together, we had the worst recession and yet the slowest recovery we've ever seen. Those two things usually don't match. Usually if you have a bad recession, you have a great recovery. And if you have a mild recession, you have a mild recovery. But we had the opposite of that. And why? And it was because of our debt. Our debt kept us. It's an anchor that we have to pull. And so what it's essentially doing is sort of robbing us of future growth. That's all this is. Debt is just basically future spending that you do today. And so we're just robbing ourselves of future growth. Now that is true. How do you get out of it? Well, I think that there's two things. Last thought, because this is a big one. Number one is, with rates as low as they are today, having debt is not so bad. If I went to many of you and said, listen, you can borrow as much money as you want, let's make it zero interest. You'd all say, like, let me borrow money at zero interest. Maybe let me borrow 1%. I'll just take as much as I can, and then I'll go and invest it or do whatever, and I'll be able to get more than that. And so really that's one of the things that's really bailed us out. But rates won't stay low forever, and eventually that will begin to bite. The way out of it is not for us, in my opinion, to have to pay a lot of that back. That would be so painful for us to think about having to cut massive spending, or to think about massive tax increases. All those things I think would be really detrimental to our economy. I think it would be just too hard to do. I think the way you get out of it is you make $21 trillion in debt or $26 trillion in debt look small. And the way you make it look small is you grow our economy. If we tripled our economy, then we've essentially cut the amount of debt per unit of our economy by a third. That's how you do it. You grow your way out of it. That said, we can't spend more than we are growing. And that's what's happened over the last 10 to 15 years. We've been spending a lot more. So the reality is, Peter, it's a complicated question. It does bite. It is future growth pulled through today. It will hinder the amount we grow in the future. We estimate by about 1 to 1.5%. So therefore, if we were going to grow at 5%, we're only going to grow at 3.5% now, because we've got this debt anchor that we're carrying along. But the magic here is for us, if we can just get through this and then freeze our spending increases, don't take any more debt, and then grow faster than your debt grows. So therefore, it gets smaller and smaller and smaller and smaller and smaller and smaller and smaller. And we don't have to pay it back. We just make it look littler by growing our economy.
So you made one big assumption, and that is that we stop or slow our spending. We've got politicians that are not inclined to do so.
That is correct, Peter. That is a very big assumption. And we haven't been able to do that. And I think at some point, we're going to have to be able to say, are we willing to be able to put future growth and take future growth from our kids and our grandkids, just so we can have a little bit more comfort today? Are we willing to do that? And we have to have leaders that have the political will to be able to do that. And so far, here's what we know. What we know is that dramatic tax decreases and spending increases typically aren't worth what is done. In the moment, when things are really bad, spending increases and things like that can certainly help. But the reality is both parties, Republicans more to reduce taxes, and Democrats oftentimes to do more social spending. Those two combinations typically, if you just look at the math, haven't been paid for in what you got out of it versus what it cost. I just think we need the political will to say, let's have reasonable taxes, reasonable spending that takes care of Americans. And then let's let our economy do the rest. One of the real magics of this economy is capitalism. If we can get that engine going, it is a magical force that can do pretty amazing things for standard of living and for people's welfare. But I'm with you, my friend. We don't have the political will to do it.
Well, let's cross our fingers that that ultimately happens, and that the drunken sailors stop drinking as much as they have been. Burt, so grateful for you to be here again. We appreciate that so much. I do have an answer to your first question. Northern Mariana Islands.
Oh my gosh. Who would have? So it's MP, and MP is Northern Mariana Islands? Wait.
That's an answer that Amy sent me a little earlier.
Well, I got to tell you, Amy gets the prize. Amy is the smartest person today. She's figured it out. So thank you, Amy. You have saved me, because if I ever have to give that slide again, I'll at least be able to know the answer. And I'll look
again,
smart.
thank you so much, Burt. For any of you who know that anyone that did not make this webinar, it will be on our website, so you can listen to Burt at a later date. And if you have suggestions for future webinars, we're happy to take them. Burt, again, thank you. And thank you all for being here. Bye-bye.